Now I have Bill Hubard from MIG and Philip Tyson from MF Global. Thanks very much indeed for bearing with us this morning, right in the middle of the Portuguese bond auction announcement. We were just talking about the Fed and QE and the possibility of bringing it back in. One question that has to be asked, so we still haven't been absolutely sure of the effect that QE has had, and indeed with interest rates the way they are, if there was more QE, and we'll talk about a little bit later about when, what effect would it have?
Well, it's interesting. I mean, you know, we've looked at some models that have been written and some Fed papers. I think the New York Fed wrote a paper about the fact that what was the impact of the 1.7 trillion original QE program we saw in the States, and they looked at the impact on yields at the long end. And there's also various sort of models that the Fed used to look at, you know, the impact of a fall in yields on GDP growth. And if you combine all that, the conclusion that you can reach is that, you know, $1 trillion worth of QE, which seems to be the sort of central expectation, would only boost GDP growth by sort of, you know, between sort of 0.1 and 0.25%. Now, obviously, you can't read too literally into those results. And, you know, if they did announce QE, there's all that sort of confidence-boosting effect, so the effect would be greater. But, you know, it would have to be significant amounts. I mean, it would have to be at least $1 trillion to make any real difference. I mean, they're buying nearly sort of 300 billion a year or so, just essentially to prevent the balance sheet from shrinking as it is. So it would have to be a significant amount, but the impact might not be all that great.
The way we're looking at it right now as well, when do you think it's likely that QE would be brought in? It's very interesting to note that the next meeting is right before the midterms. Is that right?
Well, it is, the 2nd and 3rd. The election is the 2nd. We'll get the results on the 3rd. So, I mean, let's look at it away from the financial markets. Politically, if they do it or they don't do it, will that help the Republicans? Will that help the Democrats? And one thing the Fed/Treasury cannot do is be political. So my feeling with what happened last night from the Fed was exactly what I was expecting. Any change would be in February in the new year. And as Philip just said, the data hasn't gotten, yay, terrific, but it hasn't gotten any worse right now. So the simple fact is the Fed very clearly has told us what they're going to do. Get ready for it. And I think one of the things to back up, here in the UK, when the Bank of England did it, if we look at their results in February and March before the bond market really started to rally, the last time I looked, the Bank of England had an £8 billion plus profit margin, okay? That goes right to the Treasury. And I mean, at one point, if the U.S., you know, the U.S. Treasury had sold some of their Citibank bonds, what was it, 47 billion or something. So this is a very profitable proposition here. And I think people are looking at the fact is, we're worried about inflation. We need inflation in the world to get the economy starting to move again.
Philip, do you think February looks likely for QE?
I think it looks more likely, but as I say, I think you're going to have to see a deterioration in the data given some of the conflicts that we've been seeing on the Fed. I mean, I think the problem is that rates are already very low. You know, more QE might push them a little bit lower, but you know, there's a big lack of confidence in the economy from both sort of, you know, consumers and you know, corporates, if you like.
Okay, Philip and Bill, thank you both very much indeed for joining us.